Howdy, everybody. Happy Friday. I am Raymond Dahlman, your humble host here at the Liberty Call. It is Friday, August 30th, 2020. Hope you're having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado, and you're missing out on some just lovely weather. So anyways, like I said, if it is your first time watching the Liberty Call, if you could do me a favor and give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All right, what's going on here? Hang on a second. Let me mute that and go back. Oh, there it is. Now I was checking on my stream to make sure it was live, and hey, there I am. So, all right, I can stop now. All righty, well, let's go ahead and jump into the markets for today. Looks like they were in a good mood here domestically. Dow Jones was up 0.55%, 228 points, closed at 41,563. S&P 500 up 1.01%, 56 points, closed at 5648. NASDAQ up 1.1%, closed at 17,709. It was up 192 points. The VIX fell 4.15% today. It's back down to 15 even. Canada up 0.51, Brazil down 0.4%, and Mexico down 0.21. Over in Europe, Germany was down 0.03, the UK down 0.04, France down 0.13, the Netherlands down 0.55, Spain was up 0.38, Italy up 0.53, Switzerland up 0.21, and Portugal up 0.69. So kind of a muted day across Europe. Russian exchanges both back in the red. MOEX down 2.15, RTSI down 1.78%. And the overnights, the Nikkei was up 0.69%. Australia up 0.58. New Zealand up 0.71. In China, the Shanghai was up 0.68. The Shenzhen component up 2.38. China A50 up 1.4. DJ Shanghai up 0.97. Hang Seng up 1.14%. And the Taiwan weighted was up 0.3. All right, so good stuff. Good stuff. All right, let me get to my chart. Here we go. Let's take off the trend lines and go to let's go to 1 week. All right. All righty, so starting out with the Dow Jones. Looks like it's going to finish the week in the green, up 0.88%. The S&P 500, it's going to finish up about 0.25%. The NASDAQ, these little candlesticks get harder to read the older I get. NASDAQ is going to be down 0.92%. The Dow Transports up about 1/3. And the Dow Utilities looks like it's going to be up about 0.97. So those are the markets for today or for the week. Let's zoom out to the daily chart and just take a peek and see what's been going on here of late. We'll zoom out a bit over here the last couple of years. 2023, we had a bit of an uptrend most of the year. We did have a downtrend, at the, I guess, late summer going into fall. And then that uptrend continued through the beginning of 2024. We zoom in here, we broke the trend and we're sideways for a while. And then we started a new uptrend where the bottoms were higher each time. And, bounced off that here the last time the markets really took a dump. So it has just been trending back up and we're right back. I think we probably broke the previous high, but we're right at it. So, and if we look over at the S&P 500, again, very similar charts. They all kind of trend the same way. Uptrend through the first 2 quarters of last year. Then we had third quarter was down. And then that uptrend, which was broken here March, April-ish. And then another uptrend, which was broken again in, when was this? About July, mid-July, and has sort of pretty much bounced back. So be curious to see what this does long term. All right, so there's your charting for the week. So it's very exciting stuff to look at. It's what I do most of the time, staring at charts and reading articles. All right, let's get into the economic data for the week. Initial jobless claims came in at 231,000 against the forecast of 232. Previous number was 233. Continuing claims came in at 1.868 million. Forecast was 1.87 million. Previous number was 1.855. Durable goods orders month over month grew at 9.9%. Forecast was 4%, and the previous number was a contraction of 6.9. Consumer confidence came in at 103.3, well above the 100.9 forecast, and the previous number was a 101.9. So the previous number was 101.9. They were forecasting it to go down by a point down to 100.9. Actually, it goes up. Again, these people who do these prognostications, I think they just are closing their eyes and throwing dice or whatever. The U.S. House Price Index year over year for this month came in at 5.1%. Previous number was a 5.9, so it has been trending down for the last few months. U.S. Home Price Index month over month showed a 0.1% contraction. The forecast was 0.1% growth. Last month's number was 0. U.S. Gross Domestic Product, the first revision came out. Previous number was, the previous number was 2.8%. Last month was revised up to 3. Forecast was 2.8, and previous quarter was 1.4%. Goods trade balance came in at 102.66 billion. So that's not excellent there. It has been growing here of the last number of months, been trending in a negative direction, which is not good, especially for the GDP numbers. Pending home sales month over month contracted at 5.5%. The forecast was 0.2% growth. Previous number was 4.8% growth. Personal income month over month grew at 0.3%. Forecast was 0.2. Previous number was a 0.2. And spending increased at 0.5%. So our income increased at 0.3 and our spending increased at 0.5. So that means we're 0.2 in the hole. Right on forecast, and the previous number was a 0.3%. And last bit of economic data, Michigan consumer sentiment came in at 67.9. Forecast was 67.8, so just a smidge over forecast. Previous number was a 66.4. All right, you feel smarter? I know I do. All righty, folks, let's load up the market recap for today. U.S. stocks higher as Fed's key inflation measure slows more than expected. Probably the PCE. I know that's their favorite. On Friday, U.S. stock climbed as key inflation measure indicated that the Federal Reserve's efforts to combat inflation are progressing well. Yeah, I can tell at the grocery store. Bolstering expectations for rate cuts as early as next month. Woohoo! We're saved. The core personal consumption expenditures, the PCE index, the Fed's favorite inflation gauge, rose 2.6% year over year in July. I'm not sure why that's a good thing. Slightly below the expected 2.7. So yeah, it was below the forecast, so they're happy. On a monthly basis, it increased by 0.2%. This data strengthened the belief that the Fed might be cutting interest rates in September. Traders now see a 68% chance of a 25 basis point cut, though the likelihood of a larger 50 basis point cut has decreased to 30%, down from 37% last week. Now, if you remember, we were talking about, the March cuts? And we were talking about that in like December and January. And I'm like, nah, it's not going to happen. This one's probably going to happen. There's really not a reason why they couldn't drop rates 0.25%. Personally, I'd keep ratcheting them up until we get inflation down to 0. And maybe some disinflation. That would be nice. How about we have some disinflation for a year or two? Yeah, it's going to put some companies out of business, but they should have prepared. All righty. Where was I? Analysts at Macquarie noted that this inflation reading likely reassures Fed Chair Jerome Powell and the FOMC committee, or the Federal Open Market Committee. I just said FOMC, about proceeding with rate cuts. Moving on to corporate earnings, Dell Technologies saw its stock rise by over 5% after the company raised its annual forecast thanks to better than expected quarterly earnings driven by record AI server revenue. UBS noted that Dell's strong AI revenue and improved margins validate the previous issues were temporary. In contrast, Ulta Beauty stock dropped 4% after the retailer lowered its annual sales and profit forecast due to weakening demand for higher priced cosmetics and fragrances. Lululemon also saw its gains reverse after cutting its annual sales and profit forecasts amid slowing demand in North America. Yeah, those housewives are buying less leggings right now because they'd rather buy food and stuff for their family. And lastly, Intel's potential spinoff. Intel stock surged over 8% following reports that the company is considering spinning off its foundry business and abandoning plans for new factories. Wedbush highlighted that separating the foundry business could create immediate value for shareholders, as ongoing losses in this segment have been dragging down Intel's overall valuation. All right, so that's all the market news there. Let's dive into just some info here. This comes from Zero Hedge, how the job market is faring as Fed shifts focus to employment. This was written by Andrew Morin of the Epoch Times. Federal Reserve Chairman Jay Powell, in his recent speech at Jackson Hole Economics Symposium, indicated that the labor market is no longer a significant source of inflationary pressure, suggesting that the Fed is not looking to further cool labor markets. This statement raises questions about the effectiveness of the Fed's tightening efforts since March of 22 and whether the red-hot post-pandemic labor market has finally cooled. I don't know if I'd call it red hot. I mean, people going back to work from jobs that they were laid off from in 2020 and 21. Again, I don't know if, I mean, I know the current administration is patting themselves on the back left and right saying, oh, look at these huge job gains. It's like, well, you got to kind of take out 2021 and look at, where were we compared to 2019 and then, say 2022. You got to kind of take out 20 and 21 because, those numbers are just so skewed. So far in 2024, the U.S. economy has added 1.9 million new jobs, an increase from 1.4 million in 23, assuming that the numbers are correct. However, the unemployment rate has risen to 4.3% from 3.5%, and several economic indicators suggest that the labor market is loosening, moving closer to pre-crisis levels. Job openings have declined by 1.1 million since September of last year, and hiring activity is at its lowest year-to-date level since 2012. Many businesses have frozen hiring, waiting on clearer economic conditions, and workers are increasingly nervous about job security. The number of people quitting their jobs has decreased, while the percentage of workers searching for new jobs has increased, reflecting rising concerns about job stability. Despite these concerns of a cooling labor market, inflation remains a concern. Although the consumer price index has stabilized, real wages have not kept pace with inflation, leaving many workers struggling with the rising cost of living. We'll see if wages had kept up with inflation, then inflation would just continue to go up, because wages are a cost to business. Maybe people who've never run a profit and loss or run a business don't know this, but you got to pay the people who work there. It's not just you sell widgets and then you're just, a bazillionaire. It's just, that's not how it works. Let's see here. Where were we? This economic uncertainty has led to an increase in the number of people working multiple jobs to meet financial needs. As the Fed prepares for potential rate cuts, the question remains whether these measures will be sufficient to prevent further job losses and support labor market. Powell's comments suggest that the Fed believes that the labor market is cooled enough, but the economic outlook remains uncertain. So, and I guess my point, everyone has just been, cheering and screaming, hoping for rate cuts. Going back to when they started raising rates, it's like, especially right now, where do you think going to say 4.5 from where we are today? What's that going to do? We're not going back to zero, because that's where the 2 and 3% mortgages were at. We're not going back there. I mean, and again, the only reason we would go back there temporarily, not for a decade, would be if some sort of catastrophe were to occur in the economy. So, mortgage crisis of 2008 and 9. The dot-com bust back in, 2000, 2001. I think there was another bust back in 98. I wasn't really paying attention to the stock market so much back then because that wasn't my job. But anyways. All right, we got one more article here, also from Zero Hedge. The Fed's fiat money is the real cause of price inflation. This was written by Tom Mullen of the Mises Wire. Mises Wire is one of my favorite places to get news. So, all right, in his article, Tom Mullen argues that the commonly accepted reason for rising prices, such as government policies, corporate greed, or supply chain disruptions, are misleading. According to Mullen, the root cause of rising prices, often labeled as inflation, in quotes, is the creation of new money by the Federal Reserve. And that's essentially it. Expanding money and credit is essentially what increases the money supply, which then you have too many dollars chasing the same or fewer goods, and then those prices go up. He points out that the original economic definition of inflation was the creation of new money and credit, not the subsequent rise in prices. By this definition, Mullen argues only the Federal Reserve can cause a general increase in prices by injecting new dollars into the economy. Mullen dismisses the idea that factors like energy policy, government spending, or corporate behavior can independently cause prices to rise across the board. He explains that if the price of one commodity, such as oil, increases due to policy decisions, the demand for other goods must decrease because the total money in the economy remains unchanged. Thus, the rise in one price should be offset by a fall in another unless new money is created. He further argues that the recent surge in prices, particularly during the COVID-19 pandemic, was driven by the Federal Reserve's massive money creation to fund government spending. Who's been saying that? Oh, wait, this guy right here. Rather than by spending itself or supply chain issues. Mullen concludes that rising prices over the past century have been due to the Fed's continual increase of the money supply, not other external factors. In his view, the blame for inflation lies squarely on the Federal Reserve's monetary policies. And I wholeheartedly agree. You should go read the Creature from Jekyll Island by, what's his name? Shoot, I can't remember. Anyways, it's an excellent book. It basically starts, at the beginning when the bankers were sneaking down to Georgia to go to Jekyll Island to their little secret hunting retreat, and under the cloak of darkness on these hidden trains. It was crazy how they did it. And then we know what happens. Basically these Fabian socialists had this master plan to control the money supply, which then they could control the economies and also control the countries around the world, with the U.S. being in charge, so which they can then control. So, all right, well, that's enough of that for today. I hope everyone got something good out of this. I know I did. All right, well, if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So feel free to go there and give me a buzz. I'd be happy to help you out. All right, well, that's everything that I had for the week. And like I said, if anyone needs me, please go to the website. Otherwise, have a fantastic weekend. Lots of college football, baseball, lots of good stuff on TV. And hey, the weather's cooling off. Well, it is here. Maybe not if you're down in Texas where you step outside and it's the temperature of the sun. But hey, up here, I'm going to spend a lot of time out, as long as it's not raining, playing with the dog, sitting in the sunlight, and having a great weekend. So hope everyone has a good day, and I'll talk to you next time. Adios.